Okay, so we're recording. So now we're going to do an investment analysis PowerPoint. I did post the one I did this morning. It's up on the YouTube, and I posted the actual video is posted, and then in the webinar file, I posted the actual PowerPoint that I used. And then now what we're going to do is we're going to do a PowerPoint and we're going to do an Excel example. So I will post that PowerPoint and I will also post the spreadsheet so you can actually look at all the formulas and what I actually did. It makes it a lot easier if you have an example. So we're really going to now start getting into how do we do investment analysis. So let's share our screen and hopefully we can find our PowerPoint. Okay, so at the end, we'll do our Excel. So we're doing investment analysis. And oh, let me put it on slideshow. We can go bigger. Okay, so what we concluded with at the end of the last lecture was today's dollar does not equal the same actual value as tomorrow's dollar. And the reason why those are not the same, if I hold $1 today and I said to you, oh, would you rather have this dollar now or this dollar a year from now? Who wants the dollar a year from now and wants to wait? Nobody is volunteering. But so that means $1 I have today is not equal to $1 I have a year from now. So which really demonstrates again that this idea that we will automatically move to sustainability is a bit flawed because we're just not going to do that. No one volunteered. But if I said to you, oh, $1 today, how much would I have to pay you to wait and get something a year from now? Would you wait for $2 a year from now versus $1 today? $3? Every time I do this when I did this in my introductory class, what we discovered is to get people to wait, I usually had to pay them about 1,000% return to wait. So that would mean, oh, if I give them $1 today and I give them, oh no, it was about 1,000, they would wait for $10. But other than that, they would just take that $1 today. And there's a lot of reason that is. And we'll talk about that and how we deal with that problem. But what we do in this class is we actually try to take tomorrow's dollar and we move it through discounting using the cost of waiting into today's value. And that lets us add everything up, because if you move all the dollars into year zero values, today's dollar, then we can go ahead and do this. So again, we have the idea of we could move dollars forward. For those of you with savings goals, for personal finance, it's all about savings goal. If I save this $1 today, how much will I have in 20 years? How much will I have in 30 years? That's really what you'll see in personal finance. So in that case, you're calculating a value in the future. But for this class, I mean, we could look at future values, but I'm going to be really honest with you. When you're doing this kind of stuff, anything more than 5 years out, it's a dicey operation. Who really can say to me what they're going to be earning in 5 years? What they're going to be valuing? What benefits they'll want? What costs they're willing to bear? We can barely get with this today. Like today, I might be able to say, oh yeah, I really like that. But tomorrow I may have a problem and I may not want that anymore. So waiting is just very difficult. So moving money forward is difficult. So what I usually end up doing is tend to thinking in how much is it worth today? And for investment analysis, that's what we do. We take all future dollars and tomorrow's dollar and we bring it back to today. So that is really what finance is all about. Believe it or not, Finance 101, this is what you do. You sit around and move money. You usually do it for businesses who are only worried about a profit, but a lot of groups, stakeholders, governments, nonprofits are also worried about trying to get things to preserve the environment. So we need to bring those environmental values in 20, 30 years if this particular force will be gone, and bring that cost of that loss back from 30 years from now to today. It's difficult to do. But there are formulas, and that's what they use. So here's kind of what you do. So here's an example of moving it to the future. So we say we deposit $100 in an account paying 4% interest annually. How much do you have in 3 years? So here, right here is the interest we earn on year 3, right? Because we only got interest for a year. Here's the interest we earn on year 2 because we got 2 years of interest, right? Because we got this year of interest for the first year. Then we took that thing and we earned interest on the interest. So here's our second year. And here, in fact, is our third year where we get interest on our interest. That's called compounding. So after 3 years, you made $112.50. So that's why you need these formulas, because you actually, as you move from year 1 to year 2, you're earning interest on the interest. So anytime you go to these get-rich-quick seminars, we're going to teach you how to multiply your money. This is what they're looking at, compounding. If you're earning, for real estate, for example, which is the business I'm in, you don't invest a lot of your own money, a lot of it's borrowed. So you can accumulate a return very quickly because real estate markets can return 15, 20% a year when they're hot. When they're not, it's bad, but when they're hot, can you imagine 3 to 4 years of a 20% return, and then you're making 20% on the 20%? You can do very well. You can also take big losses when they're going negative. Hence, real estate tends to drive some problems in the economy because people will get in over their head. But this is an example of a formula you use to do compounding. So let's say someone offered you a deal. You can either have $285 today or $100 a year for 3 years. Which one do you pick? $285 today or $100 a year for 3 years? If you didn't understand about discounting, you would think that you're getting $300 because you 100 years, 100 a year for year 1, 2, 3, 300. But you cannot do that. You cannot do that because you need to discount. So the present value is determined by this formula. Here's the first one, the first year. Here's the second year. And here's the third year. And what you're basically doing is accounting for the cost of waiting. This cost of waiting is 8%. You waited 1 year, so you only have it one time. So you reduce it by that 8% cost. And that's the present value of this first $100. Then the second $100, here's how you get that one to come to present value. And here's the third one. So all in all, the present value of this $100 a year is only $257.70. So if I offered you this choice, you should take the $285 today. Don't wait, because the cost of waiting of 8% produces a present value of that stream of $100 that is less than what I'm offering you today. So you are not making 8% if you wait. You're making less than 8%. So this is kind of the rationale that you're using, and then it generalizes into formulas. So you can actually do these by hand. Very difficult to do. In my day, we used tables, so it did some of the multiplication for you. Lastly, we have Excel. That's what we're going to use. So I think let's all do that. Some people keep trying to do it by hand. I wouldn't do that. Just turn in your spreadsheets, and we're going to learn how to do one today. So there's kind of 4 variables that I just talked about, right? We have the present value. We have the future value, $100 in year 1, $100 in year 2, $100 in year 3. We have the number of years, 1, 2, 3, and we have the cost of waiting. So we have basically 4 pieces of information that we talk about when we calculate present value. Generally, we are thinking, oh, we don't know present value, but if we know these 3, we can calculate it. But that doesn't have to be the case. It may be that you have the present value, you have the future value, and you want to know what you're really earning on it. That's possible. Another option might be the time periods. How long does it take me to pay back this cost or to reach a positive return? So there's different ways you can solve in these formulas, and all of your questions that you'll be given on the assignments basically force you to pick which one you're solving for, and then you have to give them data about the other 3 in your spreadsheet, and the spreadsheet will give you the answer. You just have to know how to do it. So that's what we need to kind of start playing around with. And you need to make sure that you understand what year 0 means, because once you put it on a spreadsheet, we start to use more numbers. We don't talk about today and tomorrow. We start assigning numbers to things because time is a numeric in this formula. 1 year, 2 years, 1 month, 2 months. You have to start getting into the numbers. So generally you think of year 0. I always think of year 0. Some people think of time 0, but I think of years, and it's usually in years. But you can do this, you know, you can get interest monthly. You can get returns monthly. You can get them daily. So you can break this down into 365 time periods per year. We're not going to do that, but you could. Excel can do this. And again, when you enter these, benefits are considered to be a positive. They're recorded as a positive number, and costs are negative, and they're recorded as a negative number. So then all you have to do is add everything up. It's super easy to put in those formulas. Okay, so future value, the main thing you need to know is, when do they occur? Does it occur in time or year 10, year 3? Because that is really important in determining how many times you need to account for the cost of waiting. If it's 3 years, you have to account for the cost of waiting from year 1 to 2, from year 0 to 1, from year 1 to 2, and from year 2 to 3. So you got 3 time periods you're trying to account for the cost of waiting. And sometimes they have this issue where you get the same amount every year. When you get the same amount every year, like I always get $100 every month or $100 every year, if it's always the same, it's something called an annuity. So don't let that phrasing throw you. If it says this investment generates an annuity for 10 years of $1,000 per year, then that means every year is $1,000. Again, this is finance. It's not economics. They have words for everything. Part of your problem here is to learn all this vocabulary, because I'm sure none of you are running around worrying about the cost of waiting, nor are you obsessing about year 0, year 1, year 2, year 3. How many years? How many years am I going to wait? Who's looking 30 years ahead? If you're going to be sustainable, what's the time frame a community runs on? What do you think? 30 years? I'm kind of thinking 100 years. And I'll tell you why I think that. If you're looking at a community, you have people from 0 to 100 in age, usually. So you will have families and communities where they will have been there. I mean, people are living to 100. So they are really experiencing 100 years of benefits and costs. And if you actually look at these discount formulas, if you have anything about above a 0.5% cost of waiting, you never get out to 100 years. If you're talking a 12% cost of waiting, you're usually only looking at stuff that goes 20, 25 years. After that, it becomes worth nothing today. If I got to wait 25 years, 30 years, that's just too far for me to imagine. So when you do that discounting, if you have a high cost of waiting, 12%, 15%, 20%, you're not going to look at anything over 25 years. Is that sustainability? So you're born, you get to be 25. Is that all you care about? Don't you kind of think you're looking to when you're 60, 70? So this is kind of a problem. This is a problem with finance as is taught without including some of these issues related to sustainability and really looking at some of these other benefits that maybe are not so easy to discern from a market. So that's what makes this kind of interesting. And then we're going to have a lot of discussion of what we call the interest rate, which I often will call the opportunity cost of waiting, because that's what I see it. Okay, lucky for you, I'm going to give it to you in class. But when you actually get out there in the real world, have you ever noticed the preoccupation with the interest rate? You read the financial pages, they're talking about it constantly. Prime went up, prime went down, mortgage costs. What's the T-bill rate? What's the rate for government debt? What's this? It changes all up and down. So there's all sorts of interest rates out there. Which one do you actually use if you're doing this as a consultant or doing it for your personal financial stuff? You got to figure that out. If you're working for a client, you let them give it to you. Private and costs of waiting for businesses, like I think mine is like 17%. But if I was a nonprofit or a government, I would probably be using something like 2 to 3%. Because governments are here to do what serves the people. Nonprofits are here to serve the people. They're not here to make money. So they're really looking at a different sort of thing. And that's why when we're looking at sustainability, the government and nonprofits come across to us as being very, very interesting and valuable, because they are more concerned with sustainability. That's their mandate. They're really there to help us when the market fails us. They are there to help us still get the goods and services that we want that are not sold on a marketplace or that we can't afford or some such. So this is what we have to remember when we look at the interest rate, because students always ask me about this. And I said it really depends on the client and what they feel their cost of waiting is. And let me just tell you, one of the main things I think about as if I was really trying to change the world and make it more sustainable would be how to make people more willing to wait. Because it seems to me we're less willing to wait over time. But back when the indigenous people inhabited the earth, a lot of them were super willing to wait. They valued old people. 100 years was very valuable to them. So there was more interest in waiting when we were less consumed with the global nature of things and the instantaneous, instant satisfaction, soundbite. We've become way less patient. I see people that can't wait for 2 seconds, or gee, let me say, I can describe all the costs in the world with a tweet. You cannot talk about all future benefits and costs in 140 characters. So this becomes kind of one of the challenges that I think about, because if we really want to be more sustainable, this is really, it's not that we don't know how to do this, take care of the world, and that we should take care of the environment. It's how to get these people to act differently. And one of the things that would naturally make them be more sustainable is a lower cost of waiting. They're more willing to wait. You don't have to pay them so much. If we didn't have to pay them so much, we would do a better job. We would be more sustainable automatically. You wouldn't have to tell us anything. I would say, oh, so it takes me 20, 30 years to get that benefit? No problem. 30 years, that's nothing. I'm down. But are you thinking 30 years ahead? Who's thinking 30 years ahead? 40 years. I'm going to sacrifice and sacrifice for 30 to 40 years and wait. And then if I sacrifice, I may not even see the benefit because it's a non-market benefit maybe generated. Maybe everyone will have a slightly cleaner river or a slightly better sky or a slightly better ecosystem. But who's going to sacrifice for 40 years to make that happen? So it's difficult. It's difficult. So this is what you're thinking about if you're a social scientist relative to sustainability. A lot of people just say, well, we should. But the thing is, do you do stuff because people tell you to? If someone tells you to do something, how likely are you to do it? A lot of people just won't do it because you told them to. Don't be telling me what to do. But if we make them more willing to wait, they will just automatically do the right thing, which is wait. It's more sustainable. So this is very difficult, but this is one of the most important things we do. And a lot of people don't really understand interest rates, which is the right one. Doesn't really matter which is the right one, but if we were all more willing to wait, then everything would be better. And I remember back in the 60s, nobody had debt, credit card debt. Nobody borrowed money. What did we do? We waited. We got like one Christmas present from Santa. You know, like one Barbie doll. I didn't get a Barbie doll. It was fifth grade. But my daughter at 4 years old had 10 of them. And by the time she was 5, she didn't want them anymore because they just didn't have a value because, oh, I have that already. That's not a value to me now. Next thing. I want the next thing. So this is something that's probably my most challenging thing because there is no one interest rate and there is no one universal willingness to wait. We just need to be more willing. And there's also problems with that. If you're waiting, if you're valuing the environment, businesses are going to have a harder time because they want that instant return. They're into profits. So you're not going to have as much economic growth. Who is going to give up their job so their child could have a job? Because if you're completely sustainable, you may not have much economic growth at all. There are no new houses. There are no new jobs. Your parents have to quit their job and then you get that job. This is why the retirement age in Morocco is 50 and the retirement age for women in China is 55. They want to get those people off the job market to generate a job for a young person. And that's how they do that. So you'll see here what we want to do is keep growing more jobs. But that economic growth really results in a higher cost of waiting. So this is why we don't like for-profit operations. But what I'm suggesting here is it's not an emotional discussion, you like them or not. It's a question of understanding how they behave and trying, if you would prefer that they behave differently, that you try to influence that behavior and proceed them naturally into the right course of action rather than be shaking your finger in their face, because that doesn't really work that well. So on we go. Okay, so time period again is usually in years, and you may need to adjust the interest rate. Sometimes interest rates are given to you like quarterly, and you're having annual time periods like yearly. So sometimes you have to adjust. And sometimes the time period may be considered infinite. Okay, if we take care of this forest can go on forever. Those benefits will last forever. And that is called in perpetuity. It goes on forever. And wouldn't we love that? That we never have a dirty ocean. It's clean forever. And we always have this forest. I don't know that's going to happen, but again, this is what we call it because it's a terminology used in finance. So I think we have one question about something going to perpetuity, or maybe two, something going to perpetuity. So that's what it is. So at any rate now, we need 3 of the 4 variables to solve any present value problem. And in general, we're solving for present value. And in general, we're given an interest rate. But out in the real world, you will have to make decisions on what is the appropriate numbers to use. And my students ask me all the time. Sienna, I think, did 30 years because that's what the biologists usually do, 30-year models on fish populations. And she was looking at fish in the ocean. I had a student who just did something for a agroforestry, fast-growing tree, and they were recommending, that the tree could be very useful for 8 years as a shade tree and nitrogen fixing. But after about 8 years, it wasn't much benefit. So we used 8 years as our time period, because after that, there didn't seem to be any benefits. So let's just go out 8 years and see if the benefits justify the cost. Is it worth it? Can we spend this now? Because, I'm just telling you, tree growing, oh boy. Can you imagine waiting? Have you ever thought about what foresters do? Sit around and watch trees grow? How long does it take to grow a good tree? 50 years? So in their lifetime, one tree grew. So this becomes very difficult when you're talking about the environment, particularly these, trees and large mammal populations that take a long time to build up because they're at the top of the food chain. So what time periods you use matter, but it generally takes some sort of thinking and review and thought and justification on what you're doing. And again, now, this is what I'm suggesting you kind of line it up like. And then what Excel does is takes this graph and figures out how to move it around. So what you're doing is setting up this timetable, and then you're using the Excel function key to do the computations of doing this, take it from the net benefit cell or location and move it back through time. And here's kind of now some samples. So this is the perpetual annual sum. I get it forever. It goes in perpetuity. And I'm showing you this because you are asked about it. This is the one we love the best because it's so simple, right? You just divide by the interest rate. So if you receive $100 every year forever, how much is that worth today? At a cost of weighting of 10% or a return of 10% for that weight, that $100 every year forever in present value is only worth $1,000. Do you find that rather shocking? 10% is in fact a pretty high cost of weighting, and most businesses are higher than 10%. Governments are lower. So at 2 to 3%, that number is going to be a lot bigger. But this is the problem. This is why businesses are preoccupied with short-term gains and not focused on the long term. And I'm not saying they're bad. I'm simply saying, look at the math. It's a function of the interest rate, the cost of weighting. So if you can change that cost of weighting, you'll change this number and people will behave differently. But until you can get them to do that, getting mad and insisting profits are not, that's not going to work. We do need jobs. We do need profits. That's where the tax dollars come from to do the government programs. So this really gets to be complex. And that's why it's so puzzling and so frustrating and generates a lot of angry words sometimes, particularly for those interested in social equity. And it's very important in sustainability to have social equity. It's getting worse. The poor are getting poorer. The rich are getting richer. And the poor are suffering from global climate change and social problems, socioeconomic problems more than ever. So this is challenging. And we are now seeing the effects of this. In the middle of a pandemic, we're having a lot of sociocultural battles. Very, very difficult. Very, very difficult. And getting mad is probably not going to ease them. What we need to do is really look at how to change some of these numbers so that you can get yourself in a different situation. And people produce this stuff. This is not, some wild animal that comes up with this. So that's why I'm very focused on this, because this is a very big problem, but not a lot of people want to talk about it because you see how thorny it is. So here we go. We also can deal with inflation, and we'll have problems dealing with that, where you can use inflated cash flows, uninflated cash flows, blah, 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 blah. But what do? I always use uninflated cash flows. That's the most conservative thing to do. If you don't do that, you end up compounding things. You're charging interest on inflation, and it gets very, very messy, and you never know if these numbers are right, because guess what? Nothing is certain. Stuff happens. So we have to worry about all this kind of stuff, and we'll talk more about it. It can be a little thorny in the calculations, but because we have Excel, we can manage it. So we will learn how to do that as it goes along. And now we're going to kind of look at this Excel thing. So we're going to stop this share, and we're going to move right into a spreadsheet so you can kind of start getting a feel for what it looks like. So let's stop this share, go to another share, which is, okay, so I made a simple spreadsheet. Let me get it up here. Focus in on our deal. Okay, so first of all, you'll notice right up here, I put in a text block. In order to do a text block, you are going to Excel, which isn't here, mind you. I'm going to go to the one here, and I'm going to go to Insert Text Block. So if I go to Insert Text Block, it lets me put it right there, and I can just adjust it however I want it. And then I just start typing my text there, and I can change the font, I can change the size, I can bold, and that's how you insert a text block. So when you're doing your homework, if you do it on Excel, you can actually provide me the answer or anything you want to say in a text block. This makes it much easier, because some of you have this, go back to Word, but let's just do it in Excel. And the reason why I want to do that is because you can link it closer when you're doing the problem. If you start going to different types of software like Word and back to Excel, it gets messy. So there we have a text block, and you can shape it any way you want it. And you see, you can flip it around, you can do everything. So up here, you see this is my text block. So if I change it, so this is our question. Suppose you want to invest $2,000 in a project that produced a net benefit of $500 a year for years 1 to 6. Your cost of waiting is 15%. Should you make the investment? Well, first, what do we have to do? Well, first, let's get the time periods. Remember, we had our 4 variables, time. So I've laid it out for years. So we have year 0. You want to invest. So we would have, here's what we want to invest. And then what did we get back? A net benefit of $500 a year for years 1 to 6. So we have year 1, year 2, year 3, year 4, year 5, and year 6. And you notice that I have this nice horizontal layout. And I'm going to, because a lot of students want to do this vertically. The reason we do it horizontally is because then you can actually put your answer over here, and then right next to it is all the data that you use to get this answer. It's way more efficient, and that's traditionally how it's done. So any of the examples that you look at in a professional consulting report, this is how they lay it out. All the drawings I did that I've showed you, this is how we lay it out. It's the easiest thing. And what's the most useful? You don't have to put year, but you could put 0, 1, 2, 3, 4, 5. You can copy and paste and move it, because some of these, I think we have something where we're deciding whether or not to go to college, and it makes you more money after you graduate for the next 40 years. So should you go to college? So you have to go out maybe sometimes 45 years. So you just keep going out and going out and going out. And then you have to fill in really what's next. Do you receive in the present, and what do you receive in the future? Well, we receive or we invest $2,000 in year 0. So we're going to put a minus 2,000. You can put that in as a currency. Like you can put it in hard yourself, or you can just type it in there, hit return, then it will enter in that cell. If you want to make this currency, you go up here to general, number, currency. Automatically makes it into currency. So you can fill this whole thing out and just make the whole row, because you could highlight the whole row, and I'll show you how to do that next. So here's year one. No, I thought I put a space in there. Okay, so the other thing you need to do, which I always mess up on, I don't hit return to get out of the cell. If you just keep typing, it will put it all in the cell you're in. So once you have it how you want it, hit return, and then it will hard record in that cell. So what do we get in year one? $500, right? And I'm thinking, I'm trying to remember, there's something, you can copy and paste this thing, or I'm thinking you can spread it, but I can't remember how you do it. I'll look it up in the
Professor, yeah, you can, if you click on the 500, the cell with the 500 in it, and then there's a little box in the bottom right corner of that cell. It's like a little square.
Oh yes,
yep,
yes, that's right. Now I'm remembering. You do like this.
Yep.
There you go. See how
George,
easy that
you
is?
said exactly what I wanted to say.
So it's really, I keep forgetting because I don't use it that much, but you see how easy this is? So, because a lot of people get very frustrated about this copy paste, or, right? So you can just, if it's the same number every year, you can pull it. Then you can also then make it a currency. So it's now looking just like we were kind of talking, right? So then all we got to do is deal with this cost of weighting. Now, there's two ways you can do this. You can hard type in this into your formula yourself, or what I usually do is I usually give it a location, and I'll tell you why. And then I hit return, and then in this cell here, I will put 15%. And we can make it bigger if we want. Anything you want to do, you can do with text, right? You can adjust the size right here to have it be larger spacing on your cell, auto adjust the size, whatever you want to do. But the reason why I put it over there is, if, for example, you want to change the spreadsheet, it's best not to hard type it into a formula. It's best to send it to a location. And then therefore, if your client changes their mind and says, oh, well, I've decided 12% is better, then you just change one number and everything recalculates. So now we're going to do the NPV, net present value. That's initially now what we're going to do because that's what the question is. Should you make the investment? How much is this $500 you get for 6 year worth? Because we spent $2,000 and this is what we got. So we're going to put it right here. And the thing is, if you go to the formulas, yeah, let's go up here. Function. So we're going to go to function. Okay, well, we'll do it from here. Normally, I just type it in because I don't really, we're going to go to NPV, right? So then you're going to tell it what you're doing. So you click in there, and the first thing you want to do is give it the rate, which is the interest rate. That's the actual formula. Look, you see that little blue thing under there? That's basically where you type in the information. So the rate right here, right? We're going to tell it is here in that location. C11. So you type C11, comma, separate it with a comma. Here's your first value, second value, third value, fourth value, and it enters the string for you, G10 to L10. So I just highlight it, hit return. So that is the present value of all this string, okay? But that's not the net present value. That's just the present value, because to get the net present value, we have to add the amount that was not discounted, and that was in year 0. So we add this, and it automatically picks up the location, F10, hit return. So you tell me, do we make the investment? Who wants to make it?
No.
Well, Jordan wins the prize because of course we don't make it. Why? We're not making 15%. The number is negative. That string of positives every year for 6 years is not enough to make a present value of $2,000. It's less than $2,000. How do we know that? Because our answer is negative. The only negative number we had was the year 0. So that costs too much to get those returns. And it's pretty darn simple. Was that hard? That was not hard. So this is what you've got to learn how to do, is do these setups. And it's not hard. You just gotta be patient because you can get confused. And a lot of the confusion is, okay, exactly what's the benefit? Where do I put it? Because we get questions like, did this $500 come at the beginning of year 1 or at the end of year 1? If it comes at the beginning of year 1, we only waited a year. If it becomes at the end of year 1, we waited 2 years. So you can get kind of confused. What? So when you actually look at the formula, you sometimes get a little confused about this. And also you notice when it says net present value, you're looking at this going, oh, all I got to do is do NPV. But if you do that, you're going to always get it wrong because you're going to ignore that year 0 value because that does not get discounted. That's a very common mistake. Let's do another one. Another thing we often do is say, okay, we're not making 15%, but how much am I making? Maybe that's enough. Maybe I don't know my cost of waiting. Maybe I need to know just how much I would make from this thing, and then I can decide. So we got something called an IRR, which is called internal rate of return, which is basically how much am I making? It's very nice. So let me just pull that thing up a little so you can see it. And then I'll post this spreadsheet when we're done, as is. So here, you're going to insert the IRR function, right? And all you got to do is give it the values. Guess is in parentheses. You don't need to give it that. So you just give it the values, but it's got to be a range with no spaces. If you get a 0 that year, then you put a 0. But if the thing only lasts 4 years, then it only goes 4 years. If another one lasts 5 years, then that one goes 5 years. So you got to make sure you get all this in. You just put in all these locations. We're making 13% on it. So for those of us who can't figure out what our cost of waiting is, I can say to you, well, does 13 work for you? How's that going for you? And you can decide. Because you've given them a different piece of information. You didn't use an already predetermined cost of waiting. What you calculated for them is the cost of waiting, actually. There are some problems with all this, let me just tell you. Because you're always assuming when you do this that you get 13% a year every time. Or if it's 15% a year, you get 15% a year every time because of the way this formula is constructed. Sometimes that's a bit of a problem. Because sometimes in my real estate world, it just doesn't really pan out. Or I have a big repair, or there's lumpiness, you know. I need to wait, save. I don't make my 17%. And then I make a big investment and I make more than 17%. So this averaging thing is sometimes a problem. And that's why a lot of times IRR is not used, and you just ask the client, well, what's your cost of waiting? And if that cost of waiting produces a positive NPV, then it's a good investment because you're assuming I would make nothing that didn't hit that 15% cost of waiting. If it didn't hit it, I wouldn't make it. I don't need to worry about it falling short. But with IRR, you're assuming that every time you're making 13%. And that just may not be true if all your other investments return 15%. It's just not accurate, right? It's just not, because it's solving for the rate you're earning. It's not really looking at what everything else in your portfolio is doing. I may have 6 houses, each one may earn a slightly different amount, but as long as they earn above my minimum threshold to invest, I'm not going to beat myself up around the head and neck. Oh, could I have made more money? I'm like, no, I made what I wanted. I'm happy. Let's go. I'm not greedy at all. If I make what I want to, then I'm happy. And I stop messing around. So I generally use an NPV. Any questions? That's kind of basically what you do. And it just gets, we add in a lot more complications relative to figuring out the effect of risk, the effect of inflation, looking at benefits from different points of view. Different stakeholders will have different NPVs because they will have different benefits that they're considering. If you're not having to pay a cost, then you're going to shove that off on somebody else. So that won't enter into your formula. But if we did the community formula, maybe it does enter in, and then we need to compare them and see how they're different, why they're different. And that's what we're going to learn once we get past this. Because this is kind of a, as you can see, if you're in a business major, you probably got this down because it's finance 101. So it's not bad, but the rest of us maybe are not doing it that much. So unless you're super into personal financial management. I kind of learned about this in high school. I mean, I actually took accounting when I was a sophomore in high school. So for me, I'm kind of used to all this, but if you're not that comfortable with these numbers, it might take you a little bit of energy. And when you go into these formulas, I don't know. Oh, it must be because I'm screen sharing. But when you go into these formulas, finance, look at all these formulas. So there's a lot of them. So a financial manager could use all of these. See, there's where you calculate present value. There's a payment. Like I want to do a mortgage, so I want to pay this loan back. The interest rate is this. How much do I have to pay each month so that at the end of 30 years, I can have this thing paid back? That's for principal payments. This is for the whole payment, principal payments, and then there's one that you can figure out how much of that payment was an interest rate. So all this stuff is used by financial managers. And there's the interest rate in a payment, the principal in a payment, and the payment itself. So you can actually figure all this out. If you're trying to do your taxes, how much interest did I pay? That's tax deductible. Well, how much did I pay down my loan? Well, that's the principal payment. So this is very, very useful. And so you want to kind of click on these formulas. So once you get up here in your Excel bar, you can click on these formulas and you can get a more thorough explanation on them. And then you can also insert the functions. So if you then, for example, wanted to do,
we're seeing a different screen than what you're working on, I think.
Really?
Or we were when you were describing. I think you're back on the normal screen. Never mind.
Okay. I think I was using the bar across the top rather than the bar on the screen share. Right? So you're seeing it now. Are you seeing the functions?
Yeah, now we're seeing it.
Are you seeing them?
No, when you click on the menu, that pop-up menu doesn't show up.
Okay, the pop-up menu is not showing up.
Yeah.
How about this one? Oh, that one's not showing up either.
Yeah, no.
Shoot, it's supposed to be a screen share. And then the other thing is there's also a sum function. So when you're adding things, you can, if you're going this way and you're adding like you may have this benefit and this benefit and this benefit, and you add them all up and net them. But what you need to now start thinking about is getting into Excel and getting familiar with these NPVs and IRRs, because you see, when I put it up there, if I put IRR here, see, there we have the case where I didn't hit return. Okay, so let's just, that's why it's giving me a 0. Okay, so let's put IRR. Then you come over here and you said equal IRR functions, right? And then do you see it below where it explains what it means?
Yes.
So you see how it gives you the formula values and guess, and that's the whole formula. So all I got to do is just highlight that whole stream, put the inside the paren, hit return, and it'll give me the number. So when you get on your Excels, or I think Google Sheets also will do it, and then you just can download it as an Excel file and then put your edits in that way. Don't send me a Google Sheet to try and fix. It gets very messy, because then I have to get into your Google Sheet and then I have to save it on a different thing. So you have your original and my suggestions, and then you can go back and try again. So that's what it looks like. A simple way. So you should be ready to get almost all of homework done because that's all this is. And then next time, tomorrow, we will probably, I think, look at either inflation. So whatever you need to do to get through homework 1, and also assignment 1 is pretty simple too. But I think the only thing you need to learn to get through those 2 is how to put inflation. If you were to inflate these streams, like year 1, if there was an inflation thing, how we would account for that. Because sometimes you can't use real numbers, you just have to deal with inflation. So we'll do that tomorrow so you can get started on homework 1, assignment 1. Any questions? And then I'll post the webinar. I'll post this Excel spreadsheet, and I will upload the YouTube. The one from this morning was uploaded at 10:30, I believe, or 10:35. So the YouTube channel address is listed in announcements. So put it in your bookmark. And then when you do the homeworks and assignments, you can literally open whatever video you want and follow through, and the PowerPoints and Excel spreadsheets examples. Because I'm going to try, if it's really thorny, I'll try to upload you an Excel example. For graduate students, not so bad, but for undergraduates, some of them have never used Excel and they get a little bit flustered. I understand it's hard if you haven't used it. I even forget. You watch me. I have to relearn it as I do it, because if you don't use it for a couple, 3 months, I haven't been doing a lot of MPBs. Mostly the students have been doing them, and when all I got to do is check them, it's a lot easier. I don't have to put in the formulas. That's time consuming. So we're pretty well done with our hour. No questions. We'll wrap it up and I'll get this posted for you. And I'll see you tomorrow kind of early in the morning, I think, because I have a dentist appointment. So we have to do it early, and then I moved into a little bit later time frame in the day. And again, if this is a problem, if you feel like you need more help, you need to meet with me, just send me an email. We can set something up. Okay. Thank you.
Thank you.
We'll stop our share.
Thank you.
Goodbye.